Really, the only two constants in life are death and taxes. No matter what, we're going to have to pay them. Government has two different ways they can affect the economy. Monetary policy, we've talked a lot about. The Fed can increase or decrease the money supply by raising interest rates, discount rates, selling bonds, some things like that. But they can also influence the economy by the way they raise and spend money. Fiscal policy is the government's way of raising and spending money, has to deal with that. So taxes usually come at us from three different sources: federal taxes, state taxes, and also local taxes. Local taxes, especially if you live in a city, can come from things like transit, as far as buses and things like that. School districts often charge a tax to be able to provide services, things like that. So there are really three types of taxes that we face on a daily basis: income tax, consumption tax, and wealth taxes. We'll go over those in depth here in just a sec. Income taxes are usually a percentage of your income. When you're hired, you typically in the United States fill out a form, a W-4 form, and you tell your employer to withhold a certain amount of money from your paycheck in order to pay that money to taxes once a year. We technically only pay income tax once a year, but we've developed a system in the US to be able to make sure that we have enough money to pay that tax when the time comes, of kind of banking it up in this form. You fill out your W form, your employer holds that taxes for you, and then once a year they will pay that towards your income taxes. Because we only do it once a year and it's an estimated amount, oftentimes we can get it wrong. Our actual income is different than what we estimated, and that can result in either more taxes being need to be paid, or oftentimes we can get a refund from our taxes, and that's always a happy day. When you've paid too much taxes throughout the year, you get a tax refund. Income tax is used by the government for general activities, just about everything they use income tax for. Payroll tax, on the other hand, is a little bit different. It does come out of your paycheck, just like your income tax can. Um, it's automatic. It's the same for everyone. It's a set rate. It's usually shared by the employer and the employee. Each party pays a little bit. You cannot get a return on these. This is your Social Security programs, your Medicaid programs, and some of those social welfare programs that um, you participate in. These are funded by payroll taxes, so people who are working actually do pay these, and there is no way to get a refund on those. The reason being is most of that money that you spend on Social Security and Medicaid is spent immediately on someone else. Here's how Social Security is supposed to work. Basically, we have people who are working right now and people who are old right now who are not working. And we decided a few years ago in America that we wanted to help support these elderly people. So we decided that people working now are going to help pay for some of their bills through taxes, Social Security tax. So right now, workers who are working today are paying for people who are retired, are helping them. What happens is these workers then have kids. Those kids grow up and become workers themselves, and then they will pay for the expenses of today's workers when they get old. So it's kind of a pay it forward type system. We hope that now, those of us that are working, like myself, I hope that 20, 30, 40 years from now, when I go to retire, that there's still people working that can help cover me. That's how Social Security is supposed to work, and that's one of the reasons why you can't get a refund on that, because it's already spent on people living now. We talked about a couple different types of taxes. Income tax is one, wealth tax is another. You pay property tax based on the value of what you own. It used to be a lot more invasive. You used to pay property tax on lots of things, everything in your house. Now we just pay it on basically land, and our houses are real estate. Those two things are the biggest property taxes that we pay nowadays. And it typically goes to fund local governments. Property taxes usually funds schools and fire departments, which would seem to make sense, right? If you live in this area, you should pay for the schools in that area or the fire department in that area. So property owners are the ones who fit most of the bill for those type of things. Capital gains tax, on the other hand, is a tax that's um, based on the sale of a property. Basically, anytime you make money doing just about anything, the government wants to take a bit of that. And to be able to live in a government that provides services, it seems only fair that we help pay for those services. So if you sell some of your property, let's say a house or a really expensive painting, and you make some money on that sale, you bought it for a certain amount, you sold it for more, then you should pay tax on that. That's called capital gains tax. Happens very often with stocks and other investments. When you spend a certain amount on Starbucks stock and you get a ridiculous amount back, well, then you should be paying taxes on those investments. Capital gains tax comes into play there. Well, how do we avoid taxes? Let's talk about that right now. Wealth taxes and your taxable income, your income tax, we can actually avoid paying some of our taxes. There are two different ways to get tax breaks. We can reduce the amount of money that we owe, that is taxable, our taxable income. These are called deductions. Right now in the United States, laws allow us to write off, the term we use is write off, the interest that we pay on our homes. So you made this much money throughout the year, and you have a home, and you have a mortgage on that home, and throughout the year the mortgage cost a certain amount of money. Well, what the government says now, the way the laws are written, you can take that amount of money that you paid on interest and subtract it from your income and pretend like you made less income. When it comes to filling out your taxes, the amount of money that you paid on your mortgage interest now takes away the amount of money that you quote unquote earned every year. So those things are not taxable. The amount of money you spent on your mortgage, business travel, childcare expense, these are deductions. You can reduce the amount of money that you can consider income. A credit, on the other hand, is different. This is a reduction in the amount of money that you would owe in taxes. So if you have children, you get a certain amount of money each year as a credit. So if you made, let's say, $50,000 and your taxes were $10,000, but you had kids, then you can reduce the amount that you owe. So that $10,000 tax would then go down by, let's say, $2,000 because you had a kid. Okay, there are ways that you can do that. So a deduction reduces the amount of income that can be taxed. A credit reduces the amount of tax that you owe. Those two things function a little bit differently. One tax that you really can't get out of is consumption tax. Every time we buy something here in the state of Idaho, we pay a tax. Some states don't have sales tax, but we do. Sales tax is a consumption tax. Sales tax is a general consumption tax. We can also use what's called an excise tax, and these are taxed on specific goods. Gasoline has lots of taxes on it. Gasoline is the price of gasoline is pretty high. Cigarettes have really high taxes. Hunting license fees, that's a specific tax on a specific good or activity. You have to pay the fee, and only those that hunt will only those that legally hunt, that buy the licenses, are the ones paying for those services to be provided. So it seems to make sense. An excise tax is very specific. Luxury taxes, a good example of this also is a sin tax. We call them sometimes colloquially a sin tax, like gambling. Gambling is taxed very high. As a society, we've determined that some of these behaviors are not quite what we would like everyone to do. And so in order to discourage some people from doing those, we've raised the taxes on those particular activities and made them more expensive to do. So gambling is expensive. Taxes, they function, there's two different systems. We've just talked about the three different types of taxes. Now there are two different systems that we can subscribe to. Tax rates, what we have here in the United States is known as a progressive tax system. That means the rate of the tax, the percentage of taxes that you're going to pay increases with the amount of money that you make. But it's not retroactive, and that's interesting to point out. So basically what happens is, let's pretend you've got a stack of cash here. It'd be really nice if I had that much cash, right? This is a picture. No, I wish it was a picture of the money I had in my closet, but it's not. So the first, let's say, $0 to $8,500, this section of the stack here, you're going to pay 10% tax on that section. Every dollar you make above $8,500, all the way up to $34,500, you're going to pay 15% on this portion. It doesn't change the amount of tax that you paid on this level of the stack, the lower level. It only changes what you pay from here up. and it keeps working that way. If you get to $34,501, you've paid 10% tax on the first little bit of money up to 8,500, 15% tax on this section of the stack, and now you're going to pay 25% tax on that section of the stack. Okay, so as you make more money, as your stack gets higher, the rates get higher, but it's only on certain sections of the stack. It doesn't mean that if you made $380,000 that your entire stack is going to be taxed at 35%. That's not how it works. It's progressive. Tax brackets work like that. Another system of tax is called regressive tax. This means that the higher the income, the lower the percentage of your income goes to taxes. That means that this would be the idea of, well, let's look at this. Sales tax is a regressive tax because lower income earners oftentimes use government services more. As a society, we've determined that maybe they should pay more, the benefits received principle, and you'll study that in the course a little bit. But I wanted to explain this, why sales tax can be considered a regressive tax. Let's look at this. Let's say Joe and Jennifer go out to buy a car. Joe spends $60,000, Jennifer spends $60,000. The tax is $3,000 no matter what, the sales tax. But Joe's income is much, much lower than Jennifer's. Let's say he makes $10,000 a year. I don't know, I'm not looking at the numbers. And Jennifer makes $500,000 a year. So if Joe bought this car and spent $3,000 in tax, the amount of tax that he spent is a pretty high percentage of his income. Compared to his income, that $3,000 is pretty high. Jennifer, on the other hand, that $3,000 is nothing. She makes a lot of money. So the percentage of her income that she spends in taxes isn't really that high. Okay? This is an example of a regressive tax, meaning that those with higher income pay less percentage of their tax. And some people think that's fair. Some people think that it's not that fair. We'll see. There are ways to do that, to look at that. So, all right, so that's kind of the quick and dirty of taxes, the way they work, the different types of taxes, and how the government can raise some money. There are other ways the government can raise money, tariffs and things like that, that we'll get into next time. We'll also talk about how the government budgets money and what they choose to spend money on. That can be a very politically charged section of the debate, but that's all right. It's something worth looking into, and we'll definitely discover that next time. I'm going to post another video to help you with your assignment coming up that has to deal with taxes, so keep an eye out for that. But thanks for watching.